Hey everyone, this is Kirk here again at OptionAlpha.com. Thanks so much for checking out this video. Welcome back. We are going to go over all of the opening, closing, and adjusting trades that we made here today on June 11th. So today we only had one of each, and I really kind of put the last one, which is the XRT trade, in the last category because it is a trade that we more or less not hedged into, but we just kind of closed out one portion of the trade. And then what we have left is basically a very simple strangle. So I kind of threw that last one here into the adjustment slash hedge because it's not necessarily a single trade that we're totally out of. We're just kind of legging out of the position in general. So let's start off with this XRT trade tonight. And what we basically did is basically sold back our long 80-81 call spread. So for those of you who have been in this trade the whole time, this was one of those custom orders like we did with Yahoo just the other day and got out of that one at a profit. And with XRT, we had to hedge this one time before and basically had this kind of lingering long call option or call spread, this 80-81, that's completely in the money. And since it was a debit spread originally, it's basically at max profit, which is 97 cents in credit. So we went ahead and sold that back to the market. The max we can sell it back to the market for is $1 in credit. You won't ever do that, but we don't want it to go all the way till expiration and get assigned because it is in the money. So if we do leave it and don't do anything with it, even though it's in the money and basically at a full profit, then we'll actually get assigned the stock on one end. We'll have to exercise the other end. It's not that we won't make any money off of it. I just don't want to pay the commissions on doing the exercise. I'd rather just close it out for a couple cents cheaper than what we actually is max profit. So what's left over in that position after we get out of that now is just our 86.84 strangle in XRT, which is actually playing out to be really, really well because it's very, very centered over where the market is currently trading. So here's a chart of XRT, or a risk diagram of XRT, and you can see that XRT is trading right now at about 85.5, and we have the 86 on the top side, that 86 put on this side. And then on the bottom side, we have an 86 call. So there's a little bit inverted, but still looks like a very normal strangle that you would typically see. So that's really what we're working with here. And ideally what we want to see is we want to see XRT close pretty much anywhere between 86 and 84. So a nice range that the stock can close in. And if we need to make adjustments along the way, obviously we will. But right now we have pretty much a range between 86, which is right about here, kind of at the top end of the range that's been rallying against, and 84. So nice little range to work in here in the next 10 to 9 days before expiration. Still feel really good about this trade. It's been a trade that's actually turned out to be really well after we made a quick adjustment at the beginning. And so we'll see what actually happens towards the end. Let's talk about the new trade that we entered today. So the new trade we entered today is UAL, which is the United Airlines conglomerate, whatever you want to call it, that's been kind of building together. And this is a pure strangle. So we actually haven't had too many of these in the portfolio just because it's really hard to find implied volatility. But this is a pure strangle trade. So if you need help on wondering what a strangle is or how to set up just a regular strangle, we do have a great video tutorial about strangles right inside the membership area. It's under the neutral strategies section where you can just go there and take a look at it. It's about a 15-minute video tutorial, and it goes through all the ins and outs of a strangle. But basically what we did is we sold only the July options, and we did the 50 call, and you notice that the 50 is kind of corresponding here to that first call right here, and then the 40 put. So that 40 put is corresponding to the put as you see the trade alert read along your screen. So the 50/40 call/put, meaning the 50 call and the 40 put, both naked, both selling those, and that gives us a total credit of 148 by selling both of those options. So I want to actually go through those on the pricing tab real quick so you guys can see exactly where those positions are. It's very well balanced, and that's what I really like about this strangle, is that it's a well balanced strangle. And what I mean by that is that we sold the 50 options, which are above the market obviously, and sold the 40 puts, which are below the market, and the market is trading right about 45. So more or less, forgetting the 26 cents that it's trading right now, we sold a spread that's about $5 wide on each end. Now, by selling that spread and taking in the credit that we took in, so we took in, again, just that credit of about $1.50 or 148, that now moves our break-even price down another dollar or up another dollar on each end. So even though we sold the 40 puts on the lower side, by selling it for a credit of about $1.40 or $1.50, we kind of move the break-even price down on the lower side to $38.50. And on the top side, even though we sold the 50 options, we moved the break-even price up just a little bit to 51.5. So that kind of widens out the spread on both ends of the spectrum. You'll notice that on the top side, the probability of getting to 50 by expiration is 79 or 80%. So that kind of leaves 20% above that risk level. So we're trading 80% odds to the top side. Now on the bottom side, it's about the same. We have the same probability. So again, you can see it's a very balanced trade on the bottom side as well. About 80% chance of getting down to 40 by expiration. So 20% that it goes below this level. So if we add the two sides together, we have a 20% probability of risk on this side, on the bottom side, and we have just about a 20% probability of risk on the top side. That basically means that we're trading with 60% chance of success in between. I know I've had a lot of people comment about this, about how to calculate that, but you basically add the probabilities of risk from both sides, subtract by 1, which is 100, and you get kind of the range between them. So we've got a 60% chance that it'll be between this range by expiration and ends up being a really good trade. We're not anticipating holding it the whole time. We just want to see some good movement in decay in the options before we actually get out of the spread. So that said, now that we know where our positioning is and kind of the spreads that we sold, why we selected it to make it both even price-wise and probability-wise on both sides. You can see that both of these probabilities are very, very similar at 79 and 78. Makes it a very balanced trade, very even trade, because we don't know where the market's going. That's ideally how you should trade these strangles. Now with UAL, you can see that implied volatility was up above about the 58th percentile today. It's back down around 51, which is fine. That's what we want. We want implied volatility to contract in this trade because we're trading just a pure naked strangle, meaning we are pure option selling. This isn't a credit spread where we're selling one and buying one or whatever the case is. We are purely selling options at this point. So the faster that implied volatility can contract and the more steady the stock can stay, the better for our position, right? But you notice that we have a nice wide range to make money. So our first strike is at 40 down below, and up top our first strike is at 50. So we have a pretty massive area that UAL can trade in. And even going back just the last 2.5 months, the stock has pretty much stayed in this range all the way through the whole 2014 year. So for the last 6 months or so, it stayed inside this range, and that's what we're betting on. We're betting that it's going to stay inside that range at least long enough for us to make some money on a move in implied volatility. So really excited about that stock. A lot of activity in it today. I know a lot of people got into it, which is great, and we'll see how that one plays out. All right, the last trade I want to go over tonight is our Pandora put, and we actually got out of this trade. Had a lot of people, again, ask me questions about why we got out of it when the stock rallied, and really the whole answer is because we actually made more than 50% of what we were targeting, right? So we had originally sold a put spread below the market. These are July options, so they're still about 35 to 38 days out in expiration, and we've made the vast majority of the potential profit we can make on this trade. Even though the stock is rallying, we want to go ahead and buy back our vertical credit spread. So we bought back the 21-20 put spread, bought it back for a 9-cent debit, and made $14 on each vertical that we bought back. You can see that we sold it for a nice healthy premium. We've made the vast majority of the potential profit we can make. It's not worth at this point, in my opinion, holding the trade for another 9 cents, another 38 days. We've not even held the trade for about 2 weeks. I think we've held the trade for maybe 3 weeks at this point. It's not worth holding it for another month and a half to make 9 cents when we've made $14 holding it about 3 weeks. So that's really the whole idea with getting rid of Pandora. Implied volatility has started to come down just a little bit, but it's still right at the 50th percentile. So this wasn't much of an implied volatility move as much as it was a move up in the underlying stock, which is what we wanted to see. We wanted to see the stock rally here as we get towards the end of June, which helped. But again, it's not worth holding it all the way till July expiration. The stock could easily turn back around and head down towards our strikes and turn this thing into a big fat loser. So again, want to take the money off the table. If the stock market's giving you an opportunity to take money, especially an opportunity to take more than 50% of your potential gains on a spread like this, you got to take the money off the table and start entering new trades. It's just smart. It's just a smart way to go about options trading. So as always, I hope you guys enjoy these videos. If you have any comments or questions about any of the trades we make today, please go ahead and add them right below this video in the comment section. If you're watching this video publicly on YouTube and going through these and you like these alerts, you got to sign up at optionalpha.com for your free trial, because you don't actually get this video or these alerts the same time that everyone else does. So if you are watching this on YouTube right now or some other website, you're getting this video about 10 to 15 days after it's already been sent out to our members. So all of these alerts and this nightly video that we send out the same day is actually very much delayed for you. So if you want to get real alerts, live time alerts, you got to sign up for our free trial at optionalpha.com. Happy trading.